Thank you so much for tuning in. We cannot wait to teach you all about this system. Please do us a favor and collect a pen, a piece of paper, anything that you're going to use to take any notes, right? We need you to take some notes because we want to make sure this information is going to stick with you and you're going to be able to apply it today. Once again, this is Ronald Madlock with No Tax Banking. And let's start this off by getting to know each other. Please put your name and your city and state in the chat, please. So we can kind of get to know each other. Let's find out where everybody's from. Do we have more people from the East Coast, the Midwest, the West Coast, the South? Okay, let's get to know each other. This is going to be an interactive presentation today. I'm going to be asking you some questions throughout. So please jump in. Let's get involved. So who are these people? I'm going to tell you, these people come from one of my favorite cartoons from when I was a kid. This is Tom and Jerry. And honestly, it took me a long time to figure out that Tom was the cat and Jerry was the mouse. But what do we always know that's happening in every single episode of this cartoon? What is happening? Put it down in the chat what you think is happening. The pictures are going to give you some hints. And yes, you're right. They're always fighting. The cat, which is Tom, is always chasing Jerry, which is the mouse, right? So we're looking at a predator and a prey type of relationship. Tom is the predator, Jerry is the prey. So more often than not, Tom is chasing after Jerry, right? And why is that, right? They have interests that are not aligned. How so? Jerry is interested in living, living well and living for a long time. Tom is interested in making sure he doesn't live well where he is inside the house and he will not live any longer, right? Jerry wants to stay alive. Tom wants to put him out of his misery. So how does that pertain to our future plans and our financial plans? I'm going to put it together for you now. Let's just start with the topic of money, your money specifically, and what are your money goals? Please put down in the chat, what are your money goals? Also, write this down in your notes. What are your money goals? You know, someone said to me, 10 things on paper have a better likelihood of being done than 10 things in your mind. And also 10 things on paper take up less bandwidth than 10 things on your mind. Basically saying that when we write down our goals, when we write down what we're trying to accomplish, we're number one, more likely to achieve those goals and work toward them. And they worry us less because it's something that we can see. It's already out of our mind onto paper. So what are your money goals? Okay, now put them in the chat. What are our money goals? See, a lot of the money goals are, hey, I want to grow money. I want to save money. I want to get out of debt. I want to pay down student loans, right? I want to build future wealth. I want to acquire assets. I want to grow my financial intelligence. However, what is the reality? What is our reality? If our goals are to get out of the debt, to grow our money, to learn more about finances, why are we always giving our money away? And a lot of times we know that we give our money away when we make purchases and things like that. But there are also ways that we give our money away and we don't even realize that it's a detriment to us, that somebody else is benefiting from us giving our money away. And The problem is we feel that those institutions, and yes, I'm talking specifically about banks, we think those institutions are there to teach us about money, to help us grow our money, to help us get out of debt. But them intervening in our financial process is the reason why we're in that debt in the first place, and we don't even know it. Let's go back to the idea of Tom and Jerry, the predator and prey. You're Jerry, and the banks are Tom. Remember that. So these are some wise words from Albert Einstein. Carry around the knowledge that everything you buy is not only costing you the face value of the product, but it's also costing you what that money would earn for the rest of your life. Think about that. Just let that marinate. Things are not just costing you the face value, but what the money, basically the money you use to purchase that item, could have earned you for the rest of your life. And let's start on the journey right here. What is your financial personality? What is your financial personality? When we begin the journey of learning about ourselves and to building wealth, we have to be honest about where we are currently. Without that honesty, we can't learn the tools to fix ourselves. That's going to help us build the foundation for our future wealth. So let's start here. Are you a debtor? Let's be honest. Are you a debtor? Are you that person with no savings? You don't have anything earning interest. You don't have any type of assets. You're borrowing. Everything's on a credit card. Hey, you want to go somewhere? No problem. I'll put it on my credit card. Hey, I want to buy something. Hey, I'll get a personal loan. Hey, are you this person that never has any savings, but you're always using a card or some form of debt to pay for everything? Now, I am not here to judge you. I'm here to help you recognize your habits and how it leads. So let me draw your attention to the animation at the bottom. And you will see this axis. It starts with 0. This is a person that's a debtor because they pay with debt. They always start at a negative position right here. They always start at a negative position. And then I'm not saying you're a bad debtor. I'm saying, you might be a person that's making your payments every month, every year, whatever the payments are required of you. And then you work really hard. You're very diligent and you pay it off and you get all the way back up to 0. You get all the way back up here to 0. But then what happens? You want to buy something else. So guess what you do? You pay the payments down until you get to 0, right? You're on this infinite loop of being negative, working your way back up to 0, but going back down again whenever you need to make a purchase. All right, now the saver. Now I have to be honest. This was my personality. This was me growing up, and I can't be the only person out there that, was taught, hey, if you can't pay cash for something, you can't afford it, don't try to buy it. And that was me, man. I was one of those people that I used to love to count my money. I don't know about you, but I used to love to count my money. Because it just felt like an accomplishment to have it. Am I the only one? Who else was a saver? Put your personality between the two personalities, put your personality down in the chat. Now, what happens to a saver's money? Let's say you put your money in the bank account, you save up, you save up, you save up. You start off at 0, you save up, you save up, you save up. But as soon as you make a purchase, what happens? You go right down to 0. I'm not going to lie to you. Every time that happened, I was sad. I was sad. I had an emotional reaction every time I knew I had to pay for something, or I was buying a new car, or I had to fix the car, or I needed to go somewhere, or or tuition payments or medical payment, whatever it was, I had an emotional reaction because I had saved up all this money. I'd watched it grow. And then in one purchase, in one fell swoop, all the money that I'd saved was gone. And I was on this cycle, and I started over and over again. Right. But I definitely know better now. But that was, in my eyes, and how I was taught and how it was shown to be the best process with finances. So what's really the difference? So at the top, you have the saver. At the bottom, you have the debtor. What is the difference? The only big difference that I see. What is the difference that you see? First, tell me the difference that you see between the two. Put in the chat, what are the difference you see between the two? The one at the top, that is the saver. The one at the bottom in red, that is the debtor. All right, and those sections that look like stairs, that is that saving or that paying off process, depending upon which personality it is. And yes, okay, yes, that is the difference. That is the difference that I see. The biggest difference is that the saver starts off above the zero, right? You're building up money, right? You're building up money. You're above zero most of the time. That is true. And of course, and conversely, the debtor is underneath zero the majority of their time, the majority of their life. They're always in debt. They're always paying something off, right? But the saver is always broke at certain points of their life, right? Because they don't have any money, right? They don't have any money. So those are those two personalities. But what do they have in common? At the end of the day, no matter which route you take, the end point is always zero. The end point is always zero. And if you just look at the saver, you didn't start off at zero. You only went down to zero when you made your purchase. So we need to find a better way. We need to find a way that you can make all the purchases you need, but you never have to go back to zero in order to feel comfortable and confident about making those purchases. So the problem is that we finance every single thing that we buy with other banking organizations, no matter if we're a debtor or a saver. That is the big problem. It's not just that we finance everything that we buy. The biggest problem is that we finance everything with other banking organizations instead of our own. What am I talking about? I'm talking about the no tax banking method, right? No tax banking, having your private bank. It combines the best of both worlds. And what are those worlds? It combines the personality of a saver with the opportunity of leverage like a debtor, using other people's money, okay? So with your own banking system, you start putting in money. And then you take out a loan. You take out a loan and your money keeps going up. You make a purchase, and the cash that you have inside of your no tax banking, it never goes away. It never loses value, and it continues to compound as you're using the debt. There's no other system like it. There's no other type of institution that offers this opportunity except for systems that use no tax banking. So how can you do this? What is this? What is this all about? No tax banking is created through high cash value, whole life, dividend producing policies. The banking policy is not an investment, it is more like a high interest savings account, right? The policy itself is not the investment. It's more like a high interest savings account that continues to compound over time, rather you use the cash that is in that policy or not. So let me just give you an example, because I know you're like, what? What is he talking about? How would you do something like that? Well, let me just walk you through a scenario. Let's say in your regular life, you'll deposit about 10,000 inside of a regular bank, right? 10,000. And let's say that they're going to give you, even though this is probably very unrealistic right now, that you will get 4% interest from the bank for depositing this money in their bank. Hey, that's pretty great. I'll take that all day, right? But what is the bank going to do? It doesn't just sit there. They're going to loan out your money to the person buying a house at 5%. They're going to loan it out to the person buying a car at 6%. They're going to loan it out to the person doing house remodel for 7%. And they're going to loan it out to the person doing a debt consolidation at a rate of around 18%. That's what they're going to do with your $10,000. And every time those people that are borrowing this money makes a payment, they're making a payment back to the bank with interest, more interest than what is owed to you from the bank, just being a depositor, right? So you're trying to add up all of this interest that the bank is getting. You're like, oh, it's like, 20%. It's like 20% interest I'm making, then minus the 4% that they're going to give me, that's only 16. No, it's more like 500%. You got to remember, none of this money is theirs. They are making money off of money that's not theirs. So you're asking me, okay, how does this fit into my life? How can this benefit me? If you use the same scenario and the only thing you did was take out the bank and instead used your life insurance policy, you can be the person making this 500% return. The only thing you switched out is that instead of going to a conventional bank, you put it in your policy, which people call their own bank, their no tax bank. And all the interest that would be paid to somebody else, this works with you personally or with family members. I've seen a lot of family members do this. There is a father out there that has about 30 or 40 policies, and each one of his kids, cars, houses, school, all of that is paid for through loans that he gives them through his policies, and they pay him back. And the beauty of it is that when he passes on, they get all of that money and that growth from those policies. So they're truly keeping it in the family. That is how you build lifetime of wealth. So let me give you another scenario, something more concrete, step by step. Okay, this is just a regular illustration for a 27-year-old that's going to pay a premium of $10,000, right? $10,000. This is just an example. That is not the minimum. I just wanted to let you know that, because sometimes people get afraid and like, oh, I can't afford that. But no, that is not the minimum. That is just for the sake of this example. And this person is paying $10,000 a year in premiums for their life insurance policy. Now, in no tax banking, there are 3 major rules, and we're going to get into it as we go along. But number 1 is you have to pay yourself first. Just like in a scenario that we explored prior to this, in order for the bank to have money, you have to give it a deposit. In order for your policy to have money in it, you have to deposit it in it. So the premiums that are paid on a yearly basis or monthly basis are deposits into your bank. So make sure you're doing that. You are paying yourself first. Number two, when you take loans, you have to pay yourself with interest. Now, me personally, I use 10% interest. Some people use 20, 30. It does not matter. All the money's going back to you anyway. So why not treat yourself, right? Be the best banker to yourself. Now, this person bought a car in year 3. So they decided to pay themselves back interest because they only took out $15,000. But looks like they paid themselves back $18,000. So they actually paid themselves back 20% in interest, right? And I want to show you something. This is the cash value. This is what we're borrowing against right here, the cash value. And notice, as they're paying things back, that cash value is still growing. It is growing and growing. So you took out 15 and you paid back 18. And at the end of that 5 years of paying off that car, they have $65,000 worth of cash value. So again, you bought the car at 15, you paid it off in 5 years. So now in 5 years, you have all the money that you put in back, plus $65,000 that you can use now to go buy another car or make another investment. It's whatever you want to do. And you see this number over here, 88,000. 88,000 was the total amount of money that was put inside of this policy. And you ask yourself how? Because over 7 years, you paid $10,000 a year, which is 70,000. You also put in 18,000 because of the car. So that together made 88,000. Then you subtracted 15,000 from it. Why? Because you took out 15,000. Okay. So that means you took out 15,000 because remember, when you pay back that 18,000, you were just paying back the money you borrowed. The only thing extra you put in was 3,000. So it's actually 73,000. So you put in a total of 73,000. And now you have a cash value of 65,000. That means that you recaptured, because number 3 is recapture, which is really pay yourself back. So you recaptured 90% of all the money that you spent. So you have this thing, this asset that you put in 73,000, and at the end of buying a car and paying it off, 90% of that money is available for you to use however you want. How powerful is that? How powerful is that? Now, think about this. How many cars have you had over your lifetime? Write that down. And right next to it, write down about how much total you've spent on those cars. Just write it down next to it. And take 10% of that number and subtract it from that larger number. That is what you would have had if you would have used this system, had available to you to use. I'm always interested. How many cars have you had over your lifetime? Me personally, I've had like maybe 5, okay? I think that's about the average, 5, right? Okay, 5, okay, right. Now, how much? What is that 9% number? What would you have today if you were to use this system over those cars? over the lifetime of you owning cars? Yes, I'm only at 90,000 myself. I'm only at 90,000 myself. Yeah, see? Now think about it. Today, what could you do with that money? That is why starting this as early as possible is so powerful. Because once you get started, it's a saying, when you have capital, opportunities arise. They arise when you have available capital. So think about all the opportunities that you would be able to take advantage now if you had that 90% of all the cars you bought in your lifetime available right now. So why do we use the insurance companies? Why do we use this type of system? Why? Because when you start a policy, you get a consistent rate of return. From the time that you start your policy, it is locked in what type of return you're going to see year over year. Guaranteed growth. It's tax-free growth. You have tax-free distributions. This is not like a 401k or IRA. When you take a distribution, you're taxed. This is not one of those systems that says that, oh, you can't touch it for 5 years. You can't touch it for 10 years. You can't touch it until you're 59 and a half. You are in complete control. That is what drew me to this system. This is what drew me to this lifestyle, really, in this process, because I'm in complete control. I decide what I do with the money. I decide how much I put in, have easy access to that money. Absolutely. Guarantee values. You cannot beat the guarantee values. Year over year, you guarantee, you know what you're going to have year over year. If you make your payments, you have guaranteed totals year after year. There's no other institution. Your 401k cannot guarantee that. Your IRA cannot guarantee anything. They can give you great illustrations that are hypothetical in nature, but the contracts, because what we're signing contracts that it is guaranteed to be there and available for us. It's guaranteed to be in this amount if we make our payments on time, every time, like we're supposed to. You can't beat it. So people always ask, well, Ronald, if this is so great, why aren't other people doing this? I'm like, a lot of people are. Well, who else? Well, GE. All these companies that you see here are really blue chip companies that everybody's pretty much heard of in the United States, have heard of, and they've used life insurance to grow their business in some way. Everybody knows the story of Walt Disney starting Disney World. He could not do that without his policy, his life insurance policy. He didn't get money to build Disney World from a bank. He built it on swampland. No bank is going to go, oh yeah, we think that your idea is so great, I'm going to give you money for swampland. They all turned him down. So he went to his life insurance policy. What else? GE. GE used life insurance so many times to float their company. Heck, Walmart. Walmart used life insurance so effectively. There are literally rules out there that call the Walmart rules, because a lot of I'll tell you all this for those small business owners out there. I'll tell you what Walmart was doing, and you can implement something similar. But Walmart was doing this. Walmart was getting life insurance on all of its employees. As soon as you become an employee, they'll get a life insurance policy out on you. They'll get a life insurance policy out on you that they will be the beneficiary, which they can do because they have a financial interest in you. You say, how so? Because without you working, their business can't run. They need you to run their, to run their day-to-day operations. So they were getting it on all of these people that they were hiring. And even if when they left the company, they still had these, like, they were still paying the premiums. So when all these people died, they were just collecting all of this premium money. They were, at some points, they were making more money off of they were making more money from the death benefit payouts than they were, in their business at some point. That's how much it was. But now you have something called key person insurance, that you can get insurance out on a person that's a part of your business that's like really important. It's usually reserved for executives or managers or, higher level managers that, absolutely, if they were out of your business, your business would take a significant dip. So you can get a life insurance policy out on them. And if something happens to them, your company will get that money in order to, hey, this is what we're going to need to stay afloat, to hire somebody else, to train somebody else, and to float our company until this very important person, a part of our company, is replaced, right? So again, all these companies have used it in their unique way. And who else? This is the biggest player in the game. No one ever believes it, but this is the biggest player in the game. Banks. That they are the largest owners of life insurance in the United States. And each one of these names, everyone knows. They are the biggest banks in the United States, and they own all of this and bank-owned life insurance. They have their own set of life insurance. Why would they want to invest in life insurance? These banks have more money tied up in life insurance than they do in stocks. Why? Life insurance have guaranteed values. You have a locked in guaranteed interest rate. You know what your returns are going to be year after year. The same things that would appease you, appease banks. They're not going to do anything that's against their interest. See, they are the prey, but are they telling you to go out and buy life insurance the way that they do? No, because they are interested in making money off of you. They are the predator, and they're not going to teach the prey to be independent from them. They're not going to teach the prey how to get away. Remember that. So this is a banking process, not a product. A lot of people get caught up in what company, what this, what that, but the life insurance companies are important, and trust me, they definitely are. But what's more important is that you know the process, you get started with the process, and you are diligent about the process. Just like a bank, and deposits, premiums need to go in, loans come out, and then you need to repay it with interest. That process keeps going. Money comes in, you loan out the money, you repay the money with interest, and it all goes back in your policy, in your pool of money. And we don't know about this. We think we know what life insurance is all about. We think we know what this product is all about and what it can do and things like that. But I'm not mad at the regular person, because 90% of the life insurance agents that I know don't have this information. They don't know this information. They've only been taught one way. So the problem is what we think is that we think we know, but just ain't so. That's really unfortunate. We think we know something, but it just ain't so. That's not the fact. We think life insurance is only for death. And I'm like, it's not. Life insurance is for taking care of things while you're living. Burial insurance is just to take care of death. Life insurance has a death benefit component of it, but that is not its main focus, or not its only focus. Thank you so much for being a part of this presentation. I really, really, really enjoyed you. I've enjoyed your time. Once again, my name is Ronald Matlock with No Tax Banking. Please feel free to email me any questions, ronald@notaxbanking.com. My website is notaxbanking.com, notaxbanking.com. And my phone number on here is 618-216-6391. It was a pleasure presenting to you today. I appreciate your time. You have a great day, and I cannot wait for you to allow us to help you get on a journey of wealth and control. Thank you.